The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everyone, and welcome to the December edition of Digging into the BI. This is where the members of Better Investing from DC, Maryland, and Virginia get together and look at the latest issue of the member-only Better Investing magazine. Welcome, whether you're a BI member or not. Tonight, we're going to be looking at SiteOne Landscaping Supply, Copart, Charter Communications, and Pool Corporation. So thank you very much, and let's get going and go to the next slide. Here's our standard disclaimer. We are doing this presentation for educational purposes only. We believe as Better Investing, you should conduct your own review and analysis of any company before you make your own investment decision. Any securities that we mention may or may not be held by the presenters. Hopefully they'll let you know if they've used them. And if we are showing you anything during these presentations, we're not endorsing or promoting the use of those websites, products, or services. We will record this and it will go up on our YouTube page, and we'll talk about that in just a moment. Next slide. So who we are, this is Better Investing. Most of the people I see in the audience look like they're BI members, but since this goes out free on YouTube, we wanted to be able to make sure that if people don't know about us, that they at least know where we're coming from. Down below are some hyperlinks, and you'll see anytime you see these blue underlines, those are hyperlinks. So if you download the handouts, you will be able to get these and you'll be able to click and take you right to those links. So we're an investment education organization, and we focus on long-term investing. And as we just said, all of us that are doing this, we're volunteers from the Mid-Atlantic region. None of us are professionals in this area. We do it for fun. Next slide. So again, we're investment education, learn by doing. Those are the two people that sort of got things started. George Nicholson on the right, Tom O'Hara on the left. In terms of that's the approach that they said, is we believe this is a learn by doing. And that's exactly what we're going to be doing tonight, is showing you what we learned and how we sort of came to our conclusions. You can then do your own study and make your own assessment. Next slide. So, like I said, you can find us on YouTube. And again, with this handout, if you click on that blue underline, it will take you right to that YouTube location. If you're up on YouTube, you can just go where the search spot is, at the green box that I've highlighted, and you can type in digging into BI. We now have, as you can see over on the left-hand side in the yellow box, we have a unique channel name at digging into BI, and you'll find us. And then finally, over on the right-hand side, these webinars that are up there are organized by chapters. And chapters are basically the little lines that you see as you're going through a video on YouTube that breaks it up so you can just advance to whatever stock you want to look at rather than listening to the entire hour. Well, we made our goal of 50 subscribers. We want to now see if we can push ourselves up to 52. So please, if you're out there and you haven't, please like and subscribe. That's how the algorithm works for YouTube, and that helps other people find us. Thank you. Next slide. So again, most of you may be regulars, but in case you are not, to how to navigate the GoToWebinar, over on the right-hand side, you'll see the sort of, that's the control panel in the grayish black there, and you can move that out and up with where the arrow is with the reddish background. It's a white arrow with the reddish background that can open and close that control panel. If you want to be able to move it where I have the green circles, you can grab it and move it from, it defaults to the left-hand side or right-hand side, upper right, but you can move that over to your left-hand side if it's better for you to see it. We have you muted. When we get to question time, you'll be unmuted for that. You can raise your hand. We do have a couple people looking at the back room to help out. And if you want to type in a question, that's that blue box in there. You can click on that, pull it out, and it'll be easier for your typing to do it, and just send that out to us. So thank you. And let's go to our next slide. And again, if people are having trouble or don't know how to use GoToWebinar, we usually have people that say, I can't hear the audio. We've done an audio check on our end, so everything's good. The one thing that could happen would be if you look at sort of the purplish darkish arrow that goes, that's going on up to audio settings, If you're on your computer and you don't have it set to computer audio, you may want to check on that. So you can also come in a second time, say on your phone, with the registration number that's there. And this is where we have the green arrow pointing out to the handouts. And those are where you can get the handouts for the slide deck tonight and the 4 completed SSGs that we are going to be doing tonight. So make sure to get those before you leave. Next slide. So again, to be able to make things easier for you in terms of viewing and capturing stuff, you can sit there, and if you look at that in the center, this red rectangular box where it has the number 1 in there, you can zoom, you can make that a full screen size so it's easier to see. If you make it greater than 100, you may not be able to see stuff in the corners, but that you can always move it back to it. And if we're going through things fast and you want to remember something, you can click on the number 2 where the screenshot is, and it will take a JPEG, a photo image of where we are, and then you can remind yourself of it for later. Let's go to our next slide. So why are we doing this? Well, we are all members of Better Investing, and we wanted to be able to show the resources that are available, whether you're a member or not. Up on the top, there's a free 90-day trial. So if you have someone who's looking to join your club, or you want to be able to get them interested in investment education, you can click on that and they can get a free 90-day trial. This is also for people that are maybe beginners. We do 2 of these SSGs in core SSG to help out, or if you're uncertain with your judgment, or if you just want to be able to see what are best practices of fundamental investors. It's not that we're necessarily gurus, it's just that we do this and you can learn by seeing how other people do it. And it's a way for the 2 Mid-Atlantic chapters to get together and to promote our model clubs and to promote our Visit a Club program. So welcome for being here, even if you're not from the Mid-Atlantic. Next slide. All right, so in just over an hour, we are going to, like I said, do these SSGs. We are taking the 2 featured stocks. That's called the stock to study and undervalued feature. Those are only available to member only, but you can be able to see our slide deck tonight, whether you're a member or not. And then we have 2 other presentations. The only requirement is that the presenters have to be able to find it either from the BI website or from a BI magazine or personal experience. But some of the locations on the magazine would be the First Cut, the online screening tools. In fact, 2 of them tonight will be coming from the screening tools. The Ticker Heat Map, Ticker Talk, weekly screens, growth screens, top 100. You can see there's a myriad of places that you can find this. And we're just trying to show you how to get the most from your BI membership. And so make sure to share this with your fellow club members as well. Next slide. So if you want to be able to see this stuff in advance and be prepared, if you go to Home About Us, and again, that's another hyperlink that will take you there, you come on down to the bottom and you can see that these presentations that we're doing tonight that are the Stock to Study Copart and the Undervalued Feature Charter Communications, they were announced on October 3rd. So it's been a while since they put up there. But since we're long-term investors and we're not trying to get in and out of the market, it's going to be just fine. But you can see they already have January and February up there. So you can start taking a look at those, and we already have people working on their presentations for those for the next 2 months. Next slide. And if you want to make sure that you don't miss any announcements, if you go into where I have the red circle under my account, you can then sit there and you'll see that where the red line is, where Cheryl's sort of pointing with the mouse. You can go there and you want to then go down to where the email and product subscription, the green circle, and that will pop out what that green box is over on the right-hand side. And you want to hit the local chapter news and events. And if you're in the Maryland chapter, you'll be sent there. If you're in the DC regional chapter there, and if you're outside that area, it will take you to whatever your local chapter is. But before you hit the Save Changes button down there, go up where the yellow highlight is and sign up for the Better Investing Weekly newsletter. And we'll talk about this on the next slide. This is a weekly member exclusive thing that shows and highlights some of the education and webinars that are coming up, first cut reports that have been submitted, stock ideas. It comes out around the close of business on Thursday. And if you signed up for it and you're not getting it, check your spam filter. But there's a couple here where they're going to do some core SSG stock analysis or tutorial. So if you have someone who's inexperienced, you can do that. Treasures, it's the end of the year, so treasures need to come up to speed. great things there, but there are several other things. I just didn't want to make it too small. Go ahead and take a look at that and you'll be able to find it. Next slide. We also are on Facebook. We put out a couple notices announcing this. You do not have to be a member. You can share it with non-members. And we're getting enough little traffic there, but go ahead and I'm putting stuff up on the DC regional chapters, so link up on top. But yeah, we are trying to be able to stay in touch with folks and be able to share it with friends again as a way to show them what we're doing and what you're doing in your club. Next slide. Jonathan, tell us what you guys are doing in the Maryland chapter.
Okay, thanks. The Maryland chapter has a few exciting events coming up for 2023. Our annual Stock Pickers contest will resume beginning around the end of January. So you can check back with for more information on the Better Investing website. And you can see that we have information on our 2022 winner, Eddie McBain. And so again, just take a look at our BI website for more additional information on the 2023 Stock Pickers contest. And Kevin is highlighting, or Shirley is highlighting, the contact information for Roger Cronchi, who is the organizer of the event. So you can have, if you have any additional questions, you can reach out to Roger Cronchi at that particular email address. Okay, thanks.
Thank you. Cheryl, tell us what's going on in the DC chapter.
In the DC chapter, we're very busy. Besides having this, being part of this webinar, we've also got 2 model investment clubs, one in Northern Virginia with Nova and one in Montgomery County, MCMC. Then we have Money Matters. They're not going to have a book discussion this month, but they will again in January. So please, if you come to the next January's Digging into the BI, we'll talk a little bit more about that. And come back again in January the 9th, because we're going to be not having the very first Monday. We're going to have the second Monday because of the New Year's holiday.
Okay. Jonathan, why don't we come back to you and tell us about what's going on with the Maryland Model Club?
Okay, the Maryland Model Investment Club has been on hiatus for the past few months. We are in the planning stages currently, and we will resume in the early part of 2023. So again, stay tuned, check the website, and we'll have more information later.
And that tiny URL down there, that's still active, correct?
That is still active, correct.
So if you want to see, if you're looking to find out more, they will have more detailed information. I think it's a really good site. Whoever put it together, kudos. So
thank you.
Okay,
but,
must have been you,
Better Investing website. The Better Investing website will probably have more up-to-date information.
Okay, next slide. Well, this is one of my 2 clubs. We're in one in the Maryland chapter and one in the DC chapter. So this is Happy Destiny. And there's 6 of us. We just had our holiday social, but I decided to put up a nice warm picture from our summer social. And we meet on the 3rd Friday. We're all online. We're all either in Maryland, DC, or Virginia. And we're going to be looking at free cash flow. And we do 2 stock studies per meeting. And we're going to be Kroger's and Decker's outdoors. And we go from 6:30 to 8:45 on the 3rd Friday of the month. So if you're interested, use that POC or point of contact, and we'll get in touch with you. Let's go to our next slide. And this is the Montgomery County Model Investment Club. And there again are all of us there. We meet on the 3rd Wednesday of the month. We've been around for 5 years. We'll soon be 6 early next year. We're going through the Adding Judgment series for our education. So we're going to be doing Setting the Low Price. And I believe, I'm not 100% certain, but I think Cadent is our stock to study and the like. But we're on GoToMeeting. You can use that link to join, to attend. It's free. We're welcome We welcome any visitors. And while we say the Rockville Library, I think we've all gotten used to just using GoToMeeting for our meetings. Let's go to our next slide. Cheryl.
Okay, back over to me. And this is the Model Investment Club of Northern Virginia, which I'm a member. We started out in 2008, and currently we have 12 partners. The next meeting is going to be in December. We've got November up there, but it is the second Tuesday of the month from 7 to 9 p.m. We also are meeting on GoToMeeting, and there is our link. We didn't know about putting pictures up, so the last time we were at Tyson's, and I couldn't take a picture at that point in time, but we will try to get one for you the next time. Education is going to be a template for averaging analysts' estimates. It's a mouthful. And the stock to study is Costco. We definitely love to have visitors, and please come and join us at that link. And we will see you from 7 to 9 on the second Tuesday. And also, we've got two things going on here that I really want to reach out to if there are any club members out there or individual investors out there. The first one is the promoting the Visit a Club. What that entails is we've had clubs that are looking for members send us a filled in form, and then we put them up there to let people in the area that are looking for a club to join know that these are clubs that are out there actively looking for members. The next thing I want to talk about is also a Visit a Club, if you will, but it's in directors of the chapters going out and visiting your club, either virtually, if you're still meeting virtually, or we can come out if you're meeting live and you're somewhat close to where a director is. And we would love to do this. We are very interested in what the clubs are looking for in terms of information or education. We have a plethora of educational opportunities that we can talk to you about, or just helping you to find out how do you get new members, or other things that are, keep new members, or find that next stock investment, the new ideas. And so these are things that we would definitely like to, as directors who have been with this for a while or somewhat experienced, and even the newer ones, come out and help you with whatever you need. Bring a dozen donuts, whatever it is. We would love to visit your club, and we've got some perks we can offer you as well. So please contact us at the DC Regional. There are contact information on the website for Better Investing, and we will set it up. Thank you.
And we'll make sure you also get in touch with the people in the Maryland chapter if you have trouble finding it. But those contact information, that email where Roger is, will be able to help you find them. All right, so now let's look at the magazine itself. So over on the left is if you get it on your app. When I've asked before how many people look at the magazine on their app, I got like no one, or one or two, but they said, no, I'd rather, they may look at the e-magazine, but most of us like to wait for that piece of paper to come on in and read it that way. But it does come out a couple weeks earlier electronically or on the e-magazine. So go ahead and take a look. You can do it on your computer, laptop, tablet, smartphone, any electronic device you can take a look at. Very searchable, and you don't have to worry about all that accumulating paper. Next slide. And so here's the Learning Center. And again, if you wanted to be able to sign up for that mobile device, see where the green arrow is on the left-hand side. That will get you the mobile devices there. It's a different sign-in than what you have for your regular BI stuff. And then down below is the red arrow where the analyst reports and other resources. Any of the stuff that's featured, the stock to study or undervalued feature, there's additional resources, and you can find it right where that red arrow is when you're taking a look at things. So those are just sort of FYI. Let's go. I think we have one or two more slides, and then we'll start doing it. Like to pick out one column from the magazine, since this is digging into the BI, and I went with a due diligence column. Thomas Saylor did. And it was interesting that he was sort of talking about some of the economic projections. I didn't put in all of it, but he was saying that Federal Reserve in May of this year felt like the natural rate of unemployment could be closer to 5%, which is about a point below where the recent levels have been. And so really interesting and easy to understand stuff about economics. So if you want to take a look, I'd recommend looking at this article from this month's magazine. Next slide. So we also feature the investment magazine stuff that's coming on. There's a lot of stuff that you can go to on that our other chapters are putting on. South Florida's been doing a 5-part series on cash flow. It's free on the first Saturdays of the month. And then that's the one that's highlighted in green. This can all be found on the last inside page of your magazine. But also the Rocky Mountain chapter, they do stuff through Colorado Free University, so it costs a nominal amount, but they have a whole series of stuff that they're doing there. So take a look and see if any of those interest you. Next slide. Well, now we're ready to do our stock presentations, and we're going to do the first two in core. Jonathan will get us going with SiteOne Landscaping, followed by Lee Outlaw. So go ahead, Jonathan.
Okay, thank you, Kevin. Next slide, please. Okay, we will be talking about SiteOne. I will be presenting this in core. Next slide. So you can find this in the screening tools of the SSG software. It's under predefined screens where you can either select the quality or the value buttons and SiteOne would pop up. Next slide. So SiteOne is a medium-sized company. It's one of the largest suppliers of landscaping tools and equipment in North America. It is a wholesale distribution business, distributing irrigation, outdoor lighting, nursery, landscape supplies, grass seeds, fertilizer. They also provide products and services for golf courses. Next slide. SiteOne is actually the sum of many different companies, starting with John Deere Landscapes in 2001. And they have acquired and merged with different companies, one of which was Lesco. Now, Lesco is a leading supplier of lawn care, landscape, and golf course products. And in 2007, they merged with Deere. In 2013, Clayton, Dubilier, and Rice acquired a majority stake in John Deere Landscapes, and they provided new leadership, which transformed the company into SiteOne at that time around 2015. And in 2016, they became a public company. Next slide. This is the largest and only natural full product line wholesale distributor of landscape supplies in a $23 billion highly fragmented market. They're more than 5 times the size of the next competitor, and they state that they only represent about 15% of market share at this time. They serve residential and commercial landscape professionals, and because of their massive scale and distribution network, they can provide value-added services and product support. They have approximately 135,000 products, over 630 branches, and 4 distribution centers. Now let's look at the pie charts. I put a red block, a box around irrigation, which represents 26% of the company's products and services. Just below that is hardscapes at 21%, and then fertilizer, seed, and other. These 3 areas represent about 65% of the company's products and services. I also put the red box around new construction, which represents 36%. So you can see that if new construction decreases for whatever reason, many of SiteOne's clients will still need to rely on their maintenance, repair, and upgrade products and services to keep them going. Next slide. So SiteOne has a university program which includes technical training, licensing, certifications, and business management seminars. They have a consultancy service which assists customers in running and expanding their businesses by providing marketing toolkits for them. They provide products and services to over 280,000 firms and individuals. And note that the top 10 customers collectively account for about 4% of their net sales in 2021. And no single customer accounts for more than 2% of their net sales. So even if they lost several of their top 10 customers, they would still maintain a profitable business. Next slide. The site developed this loyalty rewards program several years ago, and this has been a phenomenal success for them. The Partners program currently consists of about 22,000 participants who can earn points and redeem these points for rewards and discounts. And this has really helped them to strengthen their customer relationships. They have invested heavily in customer relation management, e-commerce, and data analytics software. And you can see that this has had a significant boost to their sales and earnings growth over the last 5 years. 50% of their net sales in 2021 was accounted for because of this Partners program. So if this is a company that you're really interested in including in your portfolio, this would be one of the growth metrics that I would be looking for and following, particularly with respect to growing their Partners program. Next slide. They have a proven track record of successful acquisitions. If you look at the bottom row, I put a red box around the total. So since 2014, they have acquired 78 businesses, which represents $1.4 billion in net sales, and they have added 320 branches. Next slide. This is how they're going to continue to grow. They grow by acquisitions. They are one of the leading industry consolidators. They have over 80 associates that are scouting for new growth opportunities. Their pipeline is deep and expanding, and they're also expanding their merger and acquisition team. So again, if this is a company that you're interested in investigating and including in your portfolio, I would monitor their acquisition progress. Next slide. This is a landscaping company. It's an outdoor company. They're going to be affected by weather. They're going to be affected by the seasons. It's a cyclical business. They've already survived the Great Recession. They've survived the pandemic with supply chain and inventory management issues. The management has done a great job maintaining this company during adverse conditions. These are temporary issues that are highly unlikely to result in long-term harm to the company. Next slide. So sales and earnings have been growing steadily since they become a public company. But you'll notice that the open circle, the blue circles, are the recent quarterly figures, and you can see that earnings are starting to slow. Next slide. Sales has doubled over the last 5 years to 16.1% growth rate. Next slide. Their earnings growth rate has been phenomenal at 38.4%, and they've got significant tailwind from 2021 and the pandemic bubble with $5.20 growth at that point. But the growth rate is much better than the industry average and the peer group average. The spreadsheet below shows the recent quarterly figures, and you can see there's a negative 8%, which is also an indication that growth metrics and fundamentals are starting to slow. Next slide.
5 minutes, Jonathan.
Thank you. Let's look at management scorecard. Profit margins have been quite decent since they become a public company. They were hovering in around the low 3%, and they increased significantly in 2020 and 2021 with a 5% average, a little bit lower than what the industry average and the peer group average is showing. Return on equity at the bottom spreadsheet has been phenomenal. It's been great, averaging 21% over the last 5 years. And this is comparable to what the peer group and industry averages are doing. Next slide. Debt. Notice the debt has been decreasing over the years. 2015, and keep in mind this company grows by acquisition. They're spending money to acquire these companies. The most recent quarterly figures also shows a continued decrease in debt. When you start to investigate this company, look at their free cash flow. Their free cash flow has been growing quite a bit. In 2018, free cash flow was $20 million. Currently, the free cash flow is $114 million. So management is doing a fantastic job growing their free cash flow. Next slide. My spreadsheet is above, and you can see from the analysts. Analysts are basically projecting the future growth for sales and earnings to slow. And I'm getting a 9% sales growth and roughly about a 9% earnings growth, which I use to calculate my projected 5-year sales growth of about a little over $5 billion. And my 5-year projected earnings growth calculates to $6.64, both of which are equivalent to what the analysts are projecting. You can see that in my spreadsheet in the red box. Next slide. Look at the historical high PE spreadsheet in the middle of this slide, which shows the last 5-year average high PE of 55. Now, I know that PEs have been slowly decreasing. Even in 2022, I use big charts to make that determination. So from 2020 through 2022, the PEs have been decreasing. So I selected a lower average high PE of 45. That helps me to calculate a high stock price of just below $300 a share, which is on the high side of what the analysts are projecting over the next 1 to 5 years, with an average of $258. Next slide.
2 minutes, Jonathan.
Okay, thank you. The closing price as of last Friday was $126.10. I used for my low price around 20% below that closing price, and I selected the low price of $98. Next slide. So I think my judgments are very reasonable, and I'm coming up with the bottom line of a compound total return of 18.8%, which I think is absolutely fantastic for this medium-sized company. Next slide. So Site is a medium-sized, moderate growing company. It's very well managed, and it's currently undervalued. However, at the very least, I think this company should be on the watch list. I think it's really flying under the radar of a lot of analysts at this point, and it's really a high quality company. Put it on your watch list, monitor the PE and a lot of the growth fundamentals, which look like they're slowing, and their slowing is probably expected considering the tailwind that they had received from the pandemic. But I think it's a fantastic company that is worth investigating further. Thank you.
Thank you, Jonathan. Okay, and next it will be Lee, and you'll be telling us about the stock to study Copart. So take it away, Lee.
Good evening. I'm Lee Outlaw, volunteer director for the DC Regional Chapter. And as Kevin said, I'll be briefing Copart, which is PI Magazine's stock to study for December using SSD Core. It trades on the NASDAQ and is a component of the S&P 500. Next slide. So Copart is a top provider of homes for vehicles accidents stolen and recovered and worn out by old age. Its chief business is charging sellers and buyers commissions for disposing of vehicles through online auctions, distributes exclusively through these online platforms. In addition to AAII, competitors include Car Auction Services and Ritchie Brothers Auctioneers. It has businesses in Canada, the UK, Bahrain, Brazil, Finland, Germany, Oman, the Republic of Ireland, and United Arab Emirates, which for 2022 represented 15.9% of total revenues. Next slide. So what is Copart? It's in the auto and truck dealership industry. It's a medium-sized company based on sales. It was founded in Oakland, California in 1982 and went public in 1994. Per its website, it's been named to Fortune's 2020 Future 50 Companies, 100 Fastest Growing Companies, and the 2021 Fortune 500 lists. Copart's services are targeted primarily at insurance companies, car dealerships, fleet operators, and vehicle rental companies. It principally sells to vehicle importers and exporters and the general public. Most of its vehicles sold are either damaged or recovered stolen vehicles, and it generates revenues from fees paid by vehicle sellers and buyers and or purchasing and reselling vehicles on its own. Next slide. So how does Copart sees itself? This screen is an image you might see when you click into Copart's website. As I said, it was founded in 1982 in a salvage yard in California. Copart considers itself the premier destination for online car auctions. Its website really drives their activities. You'll see in real time how many auctions are ongoing, their locations, and vehicle inventories. Their web links contain a wealth of useful information about their products, requirements, and processing, as well as informative videos. And there are also comprehensive vehicle reports and pictures of each vehicle. Next slide. So selling over 3 million vehicles a year with a large inventory of available vehicles, you have to pay to play. It has 3 types of memberships: guests, which is no fees. You can get informative emails, but you can't bid. There's a basic membership that's $99 annually. You can bid on and win 1 vehicle at a time, up to 5 a year with the deposit. You're limited on your buying power up to $2,000 a year, or $2,000 before a deposit is required. Over that amount, you have to pay 10% of the what you plan to bid as a deposit. And then there's a premier membership, which is $249 a year plus a one-time fully refundable deposit, and you can bid up to 110K in US dollars a day. Next slide. So Copart offers delivery and transportation assistance. You can also get on-site assistance before bidding from their staffs at their various locations, and it has flexible payment options. Next slide. Okay, so Copart has a downloadable app. As the slide says, you can essentially bid from wherever you choose. And Copart also offers a pre-bid option. Next slide. Okay, I intended to use this link to give you a little promotional presentation from the company, but I'll pass on this. Next slide. Okay, so some analyst report. This one is from CFRA. Key points: the industry, the retail automobile industry is ranked 13th of 93 industries for timeliness as of the 21st of October. Wholesale retail selling prices are softening in response to supply chain issues. Players in this industry have enjoyed their share of profits and upside during the pandemic due to increased average selling prices, ASPs, but this is expected to change and return to normal levels. That said, CFRA expects ASPs to continue to remain higher than their pre-pandemic levels, as it is rare for prices to be revised drastically lower. Plus, vehicles are getting content heavy and expensive to manufacture. Next slide. So here's a Value Line analyst report. It's dated October 21st. And I have to say that this report, well, Copart had a stock split on the 3rd of November. So the prices and the share info, per share info has to be halved. The revenue rate info should hold up. The oval on this slide highlights that Copart's price is congruent with Value Line. Performance results indicate Copart had a good year. Preceding industry comments concerning near-term headwinds apply to Copart. The fact that car models are equipped with complex technology, making them difficult to repair, bodes well for salvage vehicles inflows in the years ahead. However, that said, the report's conclusion is that over the 25 to 27 period is shown in upper left projections, expected limited room to recover. Let's see. Okay, that's it for this slide. Next slide.
4 minutes, Lee, 4 minutes.
Okay, getting to the CFRA analyst report. CFRA considers Copart a strong buy. You can see that it's given a 5 fair value rank, and fair value is 77.34, low volatility, neutral insider activity. Next slide. Basically, these are the Morningstar competitors. There's no Value Line analysts assigned to any of these stocks. Value Line considers Copart to have a high or a wide moat compared to the other two, and they consider it at a premium price. Next slide. Looking at the visual analysis, Copart looks pretty good. One comment I'll make is that you see a downshift, downtrend EPS data, excuse me, for the first quarter, and that was attributed to damage caused by Hurricane Ian. Next slide. Historical sales reflect positively Copart against its competitors. Just a couple notes. One of its competitors has agreed to acquire AAII in the first half of 2023, and Carvana recently was acquired Call Auction Services. So in some respects, this sub-industry is consolidating. Next slide. Okay, Copart
2 minutes.
Okay, Copart outperforms its competitors for earnings per share. Next slide. Copart performs well across the board in these management categories, far exceeding competitors, peers, and industries in pre-tax profit and debt to capital. Next slide. Okay, here are my analyst estimates. I'll just say that it's kind of difficult to make comparisons because apple to apples in terms of differences in time period and a mix of year over year and analyzed rates. But just quickly, I decided to use the Value Line rates growth for sales and earnings just to be conservative. Next slide. So Here is the for sales information. And you can see I use 6.5. And you'll also see that the projected sales using their value lines recommended produces projected sales well above what they had in the value line. Next slide. Same goes for earnings per share. I use their 7, and again, produce projected EPS above what they showed on their value line. Next slide. And here are the judgments. I use the average of the high PE since they look fairly consistent the last 5 years, as well as the high earnings per share forecast to give me a high price of 110 and 70. Next slide. And for low price, I use 53.2, which happened to be 80% of the 30 November closed. And next, which is fairly close to its 52-week low. Next slide. So this gives me a buy for Copart. It's 3.3 to 1 upside downside ratio. Next slide. And here are my conclusions. Medium-sized, steady growth stock. I consider a well-managed company. It's trading, it's fairly priced as it's trading slightly above its 5-year average PE. I consider it a worthy candidate for the watch list, and it's a buy up to $67.60. And just for information, it closed today at, let's see, what did it close today? 65.70. And that's it.
Thank you, Lee. Appreciate it. All right, so now we're going to switch to the second half where we're going to be looking at 2 stocks in SSG Plus. We're going to do Charter Communications and Pool Corporation. So I'll go next with the undervalued feature. Let's go to the next slide. So this is Charter Communications. They're on NASDAQ. And they were, I'm sorry, it says here stock to study. That's a mistake. It's the undervalued feature. But hey, well, this is what you get for having non-professionals put this together. Next slide. So this comes from the undervalued feature. You know, they pointed out that in this article that 21,000 broadband customers went off of Charter Communication in Q2 of this year. That's the first time it's ever happened. And they think that that setback, along with some other things, may reflect the fact that Charter's share price has gone down 50% in the last 12 months. There are concerns, and it's not even the elephant in the room. It's the obvious thing that a lot of the different delivery technologies, 5G, fixed wireless, fiber to home, low orbit satellites have all contributed to the pullback. The company's debt is relatively high at $95 billion, but they do have a really good, strong cash flow to help pay down their debt. And they're having a new CEO come on. The current CEO has been in there for 12 to 14 years, and they have an aggressive share repurchasing plan. So those are some of the things that they think make this a potential for coming out. So let's sort of investigate, and let's go to our next slide. So it's in the S&P 500. It's also in a subset that's called the S&P 100, which is inside that. So those are the largest of them. With its sale size, this is even larger than large in my estimation. You get something over 50 billion, and this is 54. That's pretty huge. Depending on how you look at it, they either were founded in 1980 or 93. They had an IPO. Then they went bankrupt, and then they came right out of bankruptcy in less than a year. And have been operating as such for the last 12 years. They operate under the Spectrum brand, and they merged with Time Warner in 2015. They're now the second largest cable provider in the US after Comcast. If you look over at Manifest, it doesn't have a great quality or core score. Sales growth is sort of so-so. Projected return isn't too bad, but if you look at the value line, there are some promising things that the relative value is a 0.69, where 1 would be ideal, and the projected is at 0.85, so there could be some PE expansion going there. At the time of this value line report, which was actually this week, they're still showing, again, a possibility of it growing up there. It has just an average financial health grade from Morningstar, and it is covered by quite a few folks. So let's go to the next slide. When you have something like this, there are a few cautionary things in the undervalued feature. I sort of like to look at an acid test. It does pass on the last 4 quarters on the latest quarter, and the return on equity over the industry are all passes. But look at those early years of the sales pre-tax profit and earnings on this from 12 to 16. They're all over the place. So that can make it look like, is this something I really want to be involved in? And we'll continue through the rest of this examination to sort of come up with that decision. Next slide. So I like to look at the CFRA report when it has a star rating on it, because they give you a really nice background on the corporate overview and the like. We jumped ahead a slide. I think we need to go back one. Go back one more. There we are. This corporate overview from CFRA is, I thought, really kind of nice. They take a lot of the stuff straight from the SEC report. So if you don't want to read the SEC reports, you can get an idea here. But you can see, you think of it as being just cable, but they have only 39% in internet, 36% in video, and they are sort of expanding out into other things as well. The one I have highlighted, Charter and Comcast have agreed to explore opportunities on a national wireless marketplace, because both of them, as cable providers, with streaming services overtaking them as a preferred location, they have to find other ways to sort of bundle things together to get people to stay with them. So there is intense competition between whether you're going to use a high-speed internet and phone services, and intense competition across the different platforms that you're going to be in. And again, it carries, at this time, it's at an $82 billion debt, and they really haven't been paying any meaningful taxes for the last couple of years, as they've sort of sorted through things. Let's go to our next slide. So the industry survey here does point out, the biggest problem that they're running into, and it's what we all know, is that people are cutting the cord. And they're leaving Charter and they're leaving Comcast and they're going to other things, whether it's Netflix or Disney, to take a look at it. But there still may be some opportunities for them to be able to take a look. The overall universe is really, really high. And the fact is that some people still like to have it for either their internet services, as well as for other programs that are not on the streaming services. Because even with the streaming, you still have to have an internet connection to get things going. So let's go to our next slide. So keep in mind, with an undervalued feature, it's not like the stock to study we just looked at. It's designed to sort of look at it over the next 18 to 24 months. It can be beaten down. It's not necessarily a long-term buy and hold, which is really different than what you see in the stock to study. So we're not going to be timing the market to get in and out, but we are going to be sort of looking at how's it going to look over the next year, year and a half. And that's short term for a lot of us long-term investors. So let's go to the next slide. I found this Deloitte State of the Media and Entertainment Outlook. There's a link there that you can pull it out. But there are really huge changes that are going on. Just like when cable replaced over-the-air network back in the 80s, maybe it was in the early 90s, there's been big changes in, their challenges from streaming videos and how they can give additional content. And one of the things that's sort of pointing out here is that one of their challenges that we have to look on the other side for entertainment is people aren't going out to the movie theater as much as they did before. So because of COVID, and even maybe because of the convenience of having stuff coming through either on a streaming service or on a cable like like we have here with Charter, is that one of the places that's getting hit by that is people don't want to be in movie theaters. When I go to the movie theater, they're never full now. It's like you can pick several seats to sit in. So that's one of the other places where they can sort of cut into things. Next slide.
5 minutes, Kevin. 5
Thank you.
minutes.
So if you want to look at, there's a corporate promotion video that's up there. I had a Motley Fool story that's talking about how cable stocks, will they be able to survive? And then the final one there on NBC News, they were talking with the Wall Street Journal reporter who covers cable TV. I found they're all pretty easy reads, and take a look at that and sort of help make your own assessments. Next slide. When we do this in plus, I took out those early years, and if we do that, we'll see really that we have rock steady sales and really increasing sales and earnings per pre-tax profit and earnings per share since 2008. And with the next quarter, that will be 5 full years. And that red current price bar is down near the 52-week low. So this could be a classic case of what we talk about as a coiled spring or a triple play. So PEs being down, price being down, and the pre-tax profit going up. Next slide. Historic sales and growth. There were some other competitors, but it's really down to them and Comcast. I put in the peer averages just to take a look, and I'll go through these kind of quickly, but they're better than the peer average. They're a little bit below Comcast on the historic sales growth. Next slide. Historic earnings, they're clearly better than Comcast, but some of that is a reflection of starting from such a really low base. I've taken some of them out, but they're still just continuing to grow and looks really pretty good. Next slide. Pre-tax profit. This one, Comcast is doing better than them, but they've been coming on up steadily. Well, they're actually sort of in that. They've been coming up in the last year or so. So let's see if they can continue to do it. So they're sort of lagging a little bit behind Comcast, but they should be able to be there going forward. Next slide. Return on equity, this is going to have a huge impact because of debt, and we'll see that on the next slide. So their return on equity is pretty good compared to the industry average. It's a little bit behind, but it's going to show up next because equity has a huge debt. The return on equity can be triggered with higher debt, and we'll see that with the next slide. Their carry, let's go to slide 85. You can see much, much higher debt. And if you look at them compared to Comcast, they're significantly higher, but they have been coming down from where they were in 15 and 16. So there's some real encouragement. They did tick up a little bit because of the pandemic, but they do plan to sort of bring this down. But this is a big concern. Next slide.
2 minutes, Kevin. 2 minutes.
Thank you. The forecast sales, I just sort of kept it on that same line at 8%. I could have done the earnings higher than the 6%. I did preferred procedure at 12. And again, they're buying back shares and they're not paying a dividend. But I wanted to be cautious to really sort of counterweight the higher debt load and the changing viewer patterns in case things sort of go south. Next slide. Section 3, I took out a whole bunch of stuff because I think those historic PEs do not matter with where the company is now. If you look at the trailing 12-month and the averages, I think somewhere in the mid-20s would not be too bad for a historic number, and that's sort of where I came forward, because otherwise your ratios on that tab will really look at like it's too good to be true. Next slide. The high and low PE, I went with 22 and 8. That gave me I could have done easily a couple higher, and I think it's just maybe a little bit, that's a little bit too pie in the sky in my view. And so I set the low price with the low PE. Normally I do something different, but because this is not, I usually use that 4BA when it's a classic upstraight and parallel growth company, and this really is sort of a turnaround play. So I still kept it there. I think it's a reasonable number from where they are. It's down about 60% from where that current price is, but it's right at near just a little bit below the 52-week low. Next slide. So here's those ratios I was talking about. If you see where the red circle is on 77, that should be 80 or better. It shows up in the audit as one of the reasons that maybe you ought to be cautious about it, which is why I made those changes to the PE ratios. because otherwise it would be too cheap and it would look too good. So this is sort of my caution to counterweight the concerns that I have. Next slide. So again, it doesn't pay a dividend, so my range of total return is between 19 and 10. I think those are reasonable projections for where they are. And again, this undervalued feature, it has some concerns. I'm not looking at this as a long-term buy and hold, but something that's sort of been beaten down that maybe we can be able to run for a little bit of a play. Next slide, and we'll do our conclusion. So it's a large size, slow growth. It's fairly well managed. It's not great on every metric. It is on sale, but again, these PEs are really, really changing from where they've been historically. So a little caution there. I think it's a buy up to 427 and it's like 395 right now. Could be a candidate to purchase, but I could see you walking away from it if you don't like the debt and you don't think that they're going to survive the cutting of the cord. But again, look at that NBC video, and I think you'll see some good things that it could still continue because broadcast television is still existing even though cables supplanted it. That's my report. Thank you. And let's go to Ed and finish this up with Pool Corporation. Take it away, Ed.
Good evening. I'm going to be doing Pool Corporation today. I found it via custom query. Next slide. Okay, so these are the parameters I use for my custom query. I normally don't get into discussing, the specifics of a query, but I do want to do it in this instance. Next slide. So I had selected an R squared of greater than 0.9. That's a measure of how straight the earnings are going to be. So as I'm looking for a conservative company, something I'm going to feel comfortable with. So consistency over long term is pretty important. I selected a medium company because I wanted to have a little bit greater growth or expected growth than with a large company. And lastly, I selected the industrial sector because of it's more of a defensive in nature, especially in these uncertain times that I don't need to describe for you guys. Next slide. So here's a classic summary slide, one of several that I'm going to be using that I got from the Pool Incorporated investor website. As you can see on the left-hand side, there are a number of key characteristics. I'll go through a few of them, but you can read for yourself. A pool, chances are you're going to have this corporation, not definitive, generally with retail and professional contractors. They interface with about 120,000 of them. They have over 200,000 products. And again, I won't go through all of these, but it is the big elephant among a field of many smaller competitors. So I mentioned that I got this off the company website. I want to highlight a little bit of a caution in terms of as you guys do your own evaluation of products. These investor websites are very, very useful, but you got to also approach it with a little bit of a critical eye. So on the left-hand side of this, I note that, in their slide, they talk about a strong growth history and all of this. And they talk about a 15% compounded annual growth rate. But in reality, that's a little misleading because between 2016 and 2019, they really actually grew at 7.2%. And it's only because of COVID that basically they saw a massive increase in terms of their sales. COVID is not likely to be a recurring phenomena here in the future. So as we analyze this company, we got to be mindful as terms of what are one-time events, either positive or negative, and then account for it in our analysis. So I just wanted to throw that out as a cautionary tale. Next slide, please. So on here, there's a slide that goes over the various business mix associated with Pool Corp. They're predominantly in the United States. They have a very small presence overseas in Europe and Canada. They in their quarterly conference call, they talk about maybe some headwinds in Europe and other places, some of it due to currency. But again, this is mostly a U.S. play for now. The bulk of the money that they make is from maintenance and repair of pools. And as I mentioned before, they generally work with contractors. And on the far right, you'll see some of the brands and networks that they kind of operate with. Next slide, please. So here's a slightly different view of some of the topics we've discussed. This is their sales profile. And I want to draw your attention to on the right side, that, as I mentioned a few seconds ago, 60 a big portion of what they do is maintenance, supplies, minor repair items. And there's a title associated with this being non-discretionary, and that's 60% of their income. There's another 20% that's somewhat discretionary. Now, why is this important? And I think it's a really key point in terms of assessing this company, and that is, if your pool breaks, you're going to fix it. So to a certain extent, they kind of view that as a non-discretionary expense. Things always break down, so there's a recurring element to it. You're always buying chemicals. You're always fixing, well, every once in a while you'll fix your pool. So these are things that really provide a strong basis for continued revenue that pool enjoys and has enjoyed over a long time, and we'll get a little bit into that later. Next slide. So one of the other slides they had on one of their presentations at one of these investor conferences had to do with their discussion about their exceptional and consistent returns back to shareholders. And I want to kind of highlight 2 points on this slide. One is that, and it's enclosed by this red circle, these are pretty strong shareholder returns. And it's not just for a few years, even going back as far as 20 years, these are very strong returns. So that's pretty important in terms of a consistent, well-run company that's earning money and returning shareholder. The second thing is, I think it's important that in that presentation, they chose to highlight this. Normally, I don't see such an emphasis on this topic. And I think that just goes further to emphasize management's concern and interest in making sure that they're providing strong returns to their shareholders. Next slide. So what do the analysts think? So here are two sniglets from both Morningstar and Value Line. On the left side, you'll see that Morningstar kind of considers it a little bit undervalued. I want to draw your attention to the economic moat, though. It is a wide moat. And in this instance, by the way, for those that do any sort of investing where they consider moat, this particular moat is a classic example of what's considered efficient scale, which is you're doing things at such a high level of scale that it is hard for your competitors to compete against you. So I thought I'd kind of highlight that. On the Value Line side, you'll see under number 2 a fairly good for increase over the future years. That's always good to see. I just wanted to reinforce that. And then at the bottom, I took out two highlighted areas in the report. One is in that report, they kind of highlighted the fact that the company's returning cash back to investors, and they do this through dividends and buybacks. At the bottom, I want to kind of highlight something here, and that is the comment there talks about, hey, top line, bottom line growth is going to taper, and it's compared to previous quarters, and this will carry on. The tone of that is a pretty negative item, and I guess this is kind of when you look at these reports from analysts, I encourage everyone to look at it very critically and say, well, is this really a negative statement? Well, it's a statement of fact. They did so well under COVID. it's hard for them to ever really repeat that sort of performance on a consistent basis. So this is a little bit of a misleading statement in that it could draw a more of a negative curtain on the stock than it really deserves. Next slide, please.
5 minutes, Ed.
So just
5
real
minutes.
quickly, thanks. So what are some of the key takeaways on here? Again, most of their income is from non-discretionary recurring sales. That's a very powerful characteristic. They're the biggest player in a fragmented market. They benefited from COVID. The growth isn't going to continue at the same pace that we saw there, but I would assert it's reasonable to assume that the growth will continue at least at the same pace that it did before. And by the way, as they're doing maintenance, there's more and more pools out there from that are potential or pool owners that are potential customers. Next slide. So let's look at it a little bit here. So what I've done here, this is a little complicated. You normally don't see this. So I'm using the trend as a projection point, and basically what you'll see is just using a straight trend, you'll see sales and historic EPS at 7.5 and 16.7. What I'm trying to show here is that I want to allow for this big bump that we've gotten over the last few years, but I want to also now make an assumption that we're going to continue more along the lines of the historic and consistent growth that the company has demonstrated, prior to COVID. So next slide. So what I did is I selected some values that are not quite at the top of the bands that I had, but they certainly are adjusted a little bit up, again, to account for this big bump, but also over at least this 5-year time frame, not outrageous growth or flat growth. Next slide.
2 minutes, Ed. 2 minutes.
Okay, so here again under the analyzing growth quality, a few things: very consistent growth of profits from 2012, 2019. I think that's outstanding. I ignore those numbers in 21 and 20 as just anomalies. I also disregard the return on equity item that I've highlighted there. Otherwise, that graph would be green. And in regards to debt to capital, again, they buy a lot of product, they hold a lot of inventory. This accounts for a fair amount of debt that's captured in this item. Next slide. So here we take a look at the trying to come up with PE ratios, even excluding the high ratio for 2020. That's a 29.4 for a high PE is just not realistic, especially in this environment, especially for me trying to have a conservative view of this company. PE contraction is certain to continue. So what do we do with that? Next slide. So let's take a look at some of the historical performance for PE. I think Jonathan alluded a little bit earlier to the use of big charts. That's where this comes from. As far as at the bottom, what range of PEs was this company trading at prior to COVID? And that was a range in which the lower number is 25. I'm going to use that number in a few seconds. On top, I also, as far as calculating a low price, I like to look, and this is not classic better investing, but I like to use technical analysis to kind of help me judge that. If I were aggressive, I'd say it's 275. Little bit less aggressive is that 240 target. I'm going to use that in a few seconds. Next slide.
1 minute, Ed. 1 minute.
Okay, thank you. Okay, number one, that's that 25 that I told you I was going to use for an average PE, average high, and the value for the low price is 240. When you crank through the numbers, this is a buy. Next slide. One thing to note here is they do offer a 1.1% dividend. Again, I'm looking at this conservatively. Every little bit counts. Next slide. So this presents the zoning for it. Kind of shows where it is relative to the buy hold line. Next slide. So Pool is a medium-sized company. It has been emphasis steadily growing. It's a well-managed company. It's slightly underpriced according to the SSG. It's a buy up to 340. And again, this is a solid company, but I think positioned to continue emphasis again, consistent growth after enjoying a one-time COVID bump in sales and earnings. And that's it. Thank you.
Thank you, Ed. We went through these really, really fast. We now sort of do our recap where we sort of ask everyone to just sort of summarize a little bit about where they are. And what we'll do is let's go to the next slide. And we use sort of the life cycle that shows up. It really came from T. Rowe Price, but we use in our digital handbook. And why don't we start with Jonathan? Why don't you tell us why you put that location for SiteOne Landscaping?
Okay, I selected still part of the explosive growth, but growth is slowing. Site really has built a dominant position in the landscaping market. It's got a very, very unique competitive advantage with their large distribution network. They're able to offer customers a lot cheaper pricing. So I think there's still a lot of runway. They also describe this 15% market share too, and they feel that there is a much more room for them to grow. And so I selected more on the latter half of the explosive growth because there is some evidence that the fundamentals are slowing a little bit.
Okay, thank you. Lee, tell us why you put that location for Copart.
Okay, so Copart's been a very strong grow in the past. I think it's dominant in its space. I was very impressed with how they've got their operations laid out on their website. I suspect it's going to be continue to be a good grower. It's been around for 30 years plus as a public company, so I'm not putting it in the mature category yet, but I still think it has a lot of potential for growth.
Okay, thank you. And I put Charter on towards the end of the mature growth. Yeah, I mean it's going to be challenged with the streaming wars that are going on, but again, there's several broadcast companies that are still very good investments. Something like a Nexstar or Sinclair or even Paramount that's tried to get into streaming. So there is sort of a role for them. And I think the people have overreacted to this concern, and it has enough money in terms of free cash flow to be able to pay down some of that debt and also be able to reduce their shares. And so this could be a really good opportunity. And like I said, it has a strong possibility of being a triple play. Over to you, Ed, and tell us why you selected that location for Pool Corp.
So Pool, as you just heard Jonathan talk about Site, shares at least a common denominator there, and it's the big player in a very large fragmented market. I think that it has demonstrated a very clear record of good growth. I think it's going to continue. It's a medium company, but I don't ever see it being that huge. I mean, it is somewhat of a niche market. So I think it's going to do well, just not spectacular, more of a steady Eddie, pun intended.
Thank you, Steady Eddie. Okay, we've gone through all of this. Let's go to our next slide. And it's now time for all of you to vote. Cheryl, if you can release that. Again, we're not necessarily pick the one that you think ought to be a buy right now, but which one do you think intrigues you enough that you want to do some further research on your own? So if you're not a panelist, you have the opportunity to vote and just vote once. I see the numbers are coming in. Let's see how we are. We just crossed the 50% threshold. Let's see where people are. We're up to 70. Can we get up into the 80% range? Couple more votes. Slow voting here. We're up over 80. Can we get one or two more? Let's see. I'm looking. It looks like it stopped. So go ahead and close it out, Cheryl. And let them see the fun. There it is. It was SiteOne pretty much beat everyone. And
Great choice, everybody.
why is that a great choice, Jonathan?
Again, I think it's a fantastic company that's just been not recognized, and I think once people start to investigate it a little more, they'll come to light. So I think it's a great company. I'm going to do a first cut on it, so I think more BI members will also be able to share in the wealth of SiteOne landscape.
Well, just for that, I'm going to put in a first cut for charter. All right, let's close this down and let's sort of finish up. If you need to be able to reach any of us, the Digging into BI, there's a Gmail account for that. If you need to reach anyone in the Maryland chapter, there's their address. There's the DC regional, and there's a picture of many of us that have been doing these presentations as we gathered at BINC. So yes, we do exist as real people, and there we are. And a couple of them are even in the audience tonight. So anyway, let's go to our next slide. If you want to be able to get more information, you can always sign up at the DC regional chapter and on the mailing list on the main page there. You can see the web address. It's up on the top in this sort of light orange or sort of pinkish or whatever color you want to call that, a light mauve. And you can be able to sign up because we send out notices. One of our directors is very good about getting that stuff out. So go ahead and sign up for that. And I think we start talking about volunteering with our next slide. And Kent, take it away.
Hi. So anyway, if you have found this to be a useful presentation and useful information, please pass the information on, direct folks to the YouTube channel or to the address that Kevin just talked about, and get them on the mailing list so they can hear more about it. Next slide, please. So the DC and Maryland chapters, and in fact, all of the chapters within Better Investing are entirely run by volunteers. And as volunteers, we get to learn all kinds of new skills, whether it's running a webinar or GoToMeeting for that matter, as well as improving our investment skills. And we get a chance to educate other folks, help educate other folks. And in the process, we end up learning probably more than we end up teaching. So that's something that's very beneficial. And I guess one of the side benefits is that as a volunteer for a chapter, whether it's the DC, Maryland, or in my case, the Alabama chapter, you all get to improve your investment knowledge, but you also get to receive some discounted rates to the Better Investing National Conference, as well as to some of the tools that we use in making these presentations. So next slide.
So we'll hold off on this and let's check. Do we have any questions? Kent, have you been looking at that? And I think Carol, we brought you over. So if you see any questions from the question box, or if people want to raise their hand, go ahead and do that at this point. What do you guys have?
Kevin, there's one question there in the question box that you probably want to answer offline regarding Motley Fool.
The answer is yes. I am a member of Motley Fool, as I'm also a member of AAII and Better Investing. So I like their stuff. They all provide a little bit different, and it helps me become a better investor.
And Mary Jo has her hand up, so let me Mary Jo, you can unmute and ask your question if you would like. Mary Jo Sherrod.
Or was it inadvertent? Okay. Anyone else have any questions?
Just want to remind people to download the handouts before we close off the webinar. You won't be able to get to the handouts when it goes up on YouTube. So if you please take this opportunity to download those, I think they will be very helpful if you watch it again.
And the YouTube video will hopefully be up maybe later on tonight if I don't have any hiccups. So, boy, kind of quiet on the question box here tonight. I see a hand just went up or went down. Went up and went down. No other questions. Okay. Well, let's at least then tell you, and we'll see if there's any more questions. But so we are going to be on the second Monday in January because, as Cheryl said it earlier, because of the holiday. So we'll be on January 9th, and we'll be looking at Ulta Beauty, which we just looked at in November, but we didn't know it was going to be the stock to study when we did our presentation. We got Gentex, and then we're also going to be looking at Fastenal and Trek. So those would be the 4 stocks we will look at. And we're going to have a second presentation in January. And if we go to the next slide, this is sort of, about every 6 months, we go back and look at some of our presentations to sort of see what's been interesting and the like. So we are now starting our 3rd year. We started in November of 2020. And so we'll be on the 4th Monday of this month, the 23rd. And we're going to look at sort of the portfolio review. I haven't decided what we're going to do, but I thought maybe it'd be nice to see how the undervalued features have performed over that time versus the stock to studies versus the individually selected stocks. And we'll have a few people, they won't be complete redos, but they'll just give people, and it won't be a 4-port, like if this was a club and we won't do a full portfolio update. There's over 100 stocks that we've looked at, or about 100 stocks we've looked at in the 2-year time. That's too much, but we'll have a few people pull out selected ones and chat about them. So that will also be up on YouTube afterwards, but we got a pretty good response from it last time, so we'll try it again. Any more questions, Carol or Kent, or is everyone quiet?
Looks like everyone's quiet. Whoops. Oh, let's see. I got one here that says Trek, TREC is not a valid ticker. It should be Trex, TREX as an X-ray.
That is correct. That's the reason I put it both as a ticker and as a name, because again, sometimes I miss on that stuff. All right, we got a couple more slides, and what I wanted to, for those people, we do have sort of a tracking portfolio on some of these. Let's go to our slide 119. Over on Manifest, some of us have a subscription. It's not an endorsement of that. But even if you're not, you can see these public dashboards to see how they've been done. So we have it sort of divided up into by each year, by which ones were the winning selections, by which ones were the undervalued features in the stock to studies. And then those were not the featured stocks. Undervalued and stock to study are considered that. And you can click on and go see that. So let's go to our next slide, and I have them all listed there. Another reason to download the handouts. So if you go to the Manifest dashboard, and again, it's free, you don't need a subscription, go under search the dashboards, type in digging, and that's all you have to do, and you will find all 7 of them. This one is highlighting the 2021 selections. If you, again, just click on that link. If you're having trouble getting there, you will get there. One more slide. And here are all 7 of them. You can click on each one to take a look. I will add the winning selection from tonight. once we're done with this. But anyway, a way to sort of keep track of it. You can also do this through your own portfolio, but we're not really doing this as managing a portfolio. We're just trying to give you some ideas and get you comfortable with your SSG judgments and to be able to exchange ideas. Next slide. So visit us. There's again the YouTube link. You can take a look at it. One final call. Any more questions, Kent or Carol?
I don't see any.
Okay.
Looks clear.
Then I think we're going to say good night, Irene. Thank you for being here, and we'll see you next month when we dig into the BI. Good night, all.
Good night, everybody.